A well-drafted estate plan can still fall short if your accounts, taxes, beneficiary, and financial plan are not aligned. Today, we're discussing how your attorney, CPA, and financial advisor work together to help make sure your plan works in real life.
Welcome to a Wiser Retirement Podcast, where we cut through the noise and bring you real, honest conversations about investing, retirement, and building lasting wealth. No sales pitches, no gimmicks, just insights to help you stop guessing and start planning your financial future.
Welcome to a Wiser Retirement Podcast. I'm Shauna Theriault, and today I'm joined by estate planning attorney Arun Gupta and Jordan Gary, CPA, with Jones & Cobb to discuss how, when it comes to estate planning, your attorney, CPA, and financial advisor need all work together. So this is really exciting. We've never had you here.
Oh, thanks for having me.
We're actually talking about before, I think this is the first time we met in person.
It is.
It's crazy. And we've been working together for a year and a half and all of that. And obviously, Arun, you and I know. So this is all the first time we're together. So This is great. So hopefully we can do this, more than once a year. That would be great.
Nice to meet you, Jordan.
It's nice to meet you as well.
Well, today, it's really important. We always talk about how I'm really excited about because we always talk about how we have, different teams and we have different layers and actually bringing us together to be able to talk about, estate planning together, how it is not only for the financial advisor, we always talk about being kind of the quarterback and we bring in the experts when we need it. And so, bringing in you, Arun, to do the documents and look at the structure. And then, of course, you to talk about Jordan, to talk about the taxes and any tax planning there. And so it's really exciting to just be sitting here in the room with all of you, both of you today and actually doing that. So, because a lot of times clients, I don't think they see what we actually do. So it's we talk about it, but it's when we bring you in and, they go and talk to you, we do truly work as a team. So it's really great. So really why estate planning requires a team. And so it's usually the way that it starts, and it can start in multiple different ways, but the way it typically starts is we're doing a full financial plan and we're just doing a full review of their situation. And maybe clients don't have an estate plan yet, meaning they don't have the documents or what have you, or maybe they do and they're outdated, or maybe they're okay, they just need to be reviewed. And so what typically happens, is we review this and we say, okay, we see, and we're not attorneys, and I am a CPA, but I got my CPA. I've talked about this before, just to understand the recommendations that I'm making because it's so impacted, taxes impact it so much. And so, but I don't prepare, I always want your blessing on things. So I'm not making the decisions on your behalf. I'm kind of saying, here's what I think, but, reach out to Jordan and make sure it looks okay. So you're still the driver in this, the driving seat of that. And so, but it helps that we're all cohesive. And typically what it looks like is, I look at an estate plan and, maybe it needs to be updated, or maybe there's holes, or maybe we've identified something because you've been so good at teaching us, what we need to look for in holes. And then understanding the tax consequences too. So I may look at, a plan and say, well, maybe they don't have an estate tax problem now, but based on projections, they're going to. So how can we get ahead of that? So there's so many things that come up, or maybe they want to do gifting and it changes. And so that's where we have to pull, it's the advisor is knowledgeable enough in all the subject areas, if you will, not the expert at every subject necessarily, depending on experience and things, but it's almost we bring in the experts at that point when we see issues, and I don't know, it's just really exciting. And so, you draft the legal documents and help ensure the estate plan. And then the CPA, you're looking at tax considerations and, what we should be thinking about and things like that. And so from your professional perspective, when you say someone, needs an estate plan, what does that mean from your perspective?
Well, usually when someone says they need an estate plan to me, it means they need a set of documents that control the disposition of their assets when they pass away. And that's usually through a will. I also draft revocable trusts for my clients. And then there's also the corresponding financial power of attorney and advanced directive for healthcare. Those are for while you're living. Usually that's what people think of when they think of estate planning documents. And when a client comes to me, usually I'm either going to create those or update those. But then there's several other related documents that are going to come up in conversations. And that's when those conversations come up, financial advisors, CPAs, it's already a signal that, hey, it's good to just get everyone looped in. Even if it's just a basic thing like, hey, can you send me an intro email? Just so I have that person's contact.
Yeah.
Because it's helpful down the road. And again, we're all on the same team, right? So, and when you talked about working together for a long time, and I read this, this podcast topic, it just brought me back to the days of we're behind the scenes, just having these deep conversations about all kinds of things about a client's financial plan, their taxes, their investments, and we're doing all of this work. And we will, give a client a recommendation for something, and there's so much that goes into it. So much that goes into
Completely. And we may have had so much conversation, and it's like, but we've put our heads together and done it. And I love that. And they don't see the nuts and bolts of us actually working together, but that's really what's happening. So Jordan, from your perspective, when, and maybe you come at it a different way, if someone needs an estate plan or you see an issue, what does that mean from your professional perspective, would you say?
Well, the first thing I think is that it's a deeper conversation. We need to understand what the goals are, what the assets are that we're talking about. It's really just getting that plan, seeing where they want to go, and how much estate planning do they need. I think everyone needs estate planning to a certain extent. For some people, it's just more involved than others, depending on what they have, what where they want things to go, and if they're looking for. I don't know if it's just tax mitigation or is it multi-generational? Is it legacy planning? So it's really just having a deeper discussion, finding out, where they want to go with their estate and helping them achieve those goals, through these partnerships between financial advisors and estate planning attorneys and with me as a CPA.
Yeah. I mean, do you ever see, and I know obviously, we refer clients to, we work with clients in the same. Do you ever see just things come up with clients? Because I feel like, having the CPA designation, I feel like clients have looked at me differently because they always see the CPA as their advisor. So it's like, it's almost a new, since I've been in the industry 29 years, it was almost like, well, I have a CPA, I don't need an advisor, so now it's like, it's almost like a dual role, but I still feel like they see the CPA as a really large advisor to them. And so do they come to you to talk about these estate planning needs? And then do you refer them to an advisor, or how do you handle that? Absolutely.
So, the questions, like I said, they go from one end of the spectrum to the other. So they can be simple questions, it can be more involved. One thing for me is that we just want to make sure that their goals are achieved. So, is it tax that they're looking for, or is it just getting out of probate? Is it just a will that they need, or is it trust that they need? What is the goal? And as far as the questions that come to me, I've seen people. Sometimes it's when you have a married couple, it's sometimes just one spouse handles everything, right? They handle all the financial aspects.
I see that a lot too. Yeah.
And if there's not good, if they haven't planned very well, then if they predecease their spouse, then the remaining spouse can be really overwhelmed by it all. And I've been involved in estate planning situations, or after someone's passed away, where if it hadn't have been for the team that the decedent had set up, then the spouse would just been completely lost. So it's beneficial to have to have a plan in place, and communication of that plan is very important as well.
Yeah, absolutely. Because, and talking about which each professional actually does. And so, I think there's a lot of overlap with what we do, but then there's still individual roles that we play in the relationship. And so, as far as an advisor is concerned, when it comes to an estate plan, we help set up accounts, through the custodian. We help, invest those accounts. We may talk about things like helping to add a beneficiary, of course, with like your blessing as the estate planning attorney. If you put together, documents and then you say, how should the beneficiaries be? But then also, from your perspective, what role do you play? And it could be while they're alive, deceased, what have you. What role do you think you play, or what role do you play with estate plans in general?
Well, naturally from my profession, it's taxes, right? I mean, that's where it's easy for me as a CPA to just come from the tax role and try to mitigate taxes, whether that's through beneficiaries, through giving, making sure people understand the implications of the types of assets they may be inheriting. Most people, they don't know, what the tax implications are when they receive an inheritance, no matter what size. I mean, some people think if they inherit just cash that they have some type of a tax, and that's not the case. That's right. Homes are a big deal. Like a lot of people ask me, "Oh, I just inherited a home. How are the taxes going to affect me?" And the chances are, if you turn around and sell it really quickly, it may not be an impact to you at all tax wise. So it's really, from my point of view, it's tax mitigation. A lot of that comes into, speaking with the taxpayer, from my case, about their basis, step up in basis, versus what happens when you pass and someone inherits for the step up versus gifting. I mean, that one's huge.
It is huge.
Yeah, people don't. And what I would like to see is people actually come to us before they make a decision on something, so that we can help them navigate. Because I've seen it before. We've had a situation where someone had gifted a home before they passed, and then they passed right after that, and then so the beneficiaries received a gift and they received inheritance, but the tax implications are completely different.
Totally. So. And it's so funny you should mention that. And I love that. That just goes to show, because you and I just did a show on that, right? We actually used that example where it's like, clients try to make it easier. So it's like, I'm going to make it easier to just pass to you. So I'm just going to put this account in your name, or I'm going to gift this house to you now, or I'm going to do whatever just to make it simpler. But first of all, there's gifting issues with that, because you're going over the 19,000 gift limit, right? So there's just gifting issues, but also that step up in cost basis, you just lost that. Absolutely. And so it's like, there's so many implications there. And so that's like evidence right there that this all crosses over, because not only are they talking to us about it, where we're trying to find these issues, and hopefully they call us and say, "Hey, I'm thinking about this," but you're right. They don't always do that. And so, it's sometimes we get it after the fact, just like you do. And we're trying to coach them into the same, there's multiple ways to do things, but, if they would come to us first and come to your planning team, all three perspectives, that is going to be so much more helpful for them, so that they don't make these that's a huge mistake that could have been prevented very easily, where it could save them a lot of tax. And so from your perspective, what is the most common misconception that people have about estate planning attorney, what an estate planning attorney does?
Well, I think that when it comes to, they ask me questions, I have to kind of step away a little bit and tell them, listen, I can give you some advice on this, but that's not my expertise. I'll defer to a financial advisor, or I'll defer it to an accountant. I can speak generally, just like, well, you're a CPA. I'm neither. I have no designations, financial or tax, but because it's all so related, naturally, we just know a lot about all of these industries.
Well, an estate planning attorney has to understand the estate plan limits and all, right?
Yes, of course.
Because you have to be able to do the exemptions and the trusts and okay.
When it comes to, I'll just give you an example, gift reporting, right? I'm not working with the IRS every day. If you make a large gift that is over the exemption, let's say it's a $20,000 gift, right? And $19,000 is the limit. I'm guessing that the IRS is probably not going to go after that $1,000 over the gift limit, right? However, I can't confidently tell them. I will tell them my advice is to do what's right, report it, use your lifetime exemption. However, I will defer to an accountant, to someone that files taxes, maybe for them also, knowing that, hey, how does this all work in practice, in reality? Those kind of situations, I like to defer a little bit more to financial advisors or CPAs for the taxes for the CPAs, and then I get questions about basis and which stocks should they, and I tell them again, listen, I can give you general advice, but I think you should speak with your financial advisor. And then it's always good for us to all know who the other person is, whether it is knowing them very well or just knowing their name. I think it's always a good idea to have contact information.
Yeah, because really legally, we're not supposed to give legal advice.
Mm-hmm.
You can do that. You're not supposed to give tax advice. We can do that. But really, I'm not signing the tax return. You are.
Mm-hmm.
So it's like the collaboration is huge, and having that team that works together. And I know, in this industry, I've had so many clients tell me it's like they get frustrated in general, where it's like they have an advisor and then they have a separate CPA and then they have, and none of them are talking. And I love, the collaboration that we get to do to be able to do it together, so that we are all talking and all of that. And so it makes it more seamless for the client too. If you work, not every firm has that where, we work together. Hopefully firms do, but not all of them do. So I have a question that is kind of off script, but I'm just curious because I've seen some situations where you have some estate planning attorneys and some CPAs that will file like the death taxes. So it's not it's not the 1041, right? So it's more of the state tax. Is that
706?
706.
The 706 is the
okay.
estate tax
So
return.
how?
Now, from my experience, I filed 706s for clients before. CPAs can file 706s but not every CPA, from my experience, does many of them or wants to touch that, and they will just say, hey, you do it. I'm fine doing it. That's basically, I do 706s, which is a federal estate tax return.
Is that only if they're a taxable estate? Or if you're doing portability too?
Yes. Okay. So lately, the ones that I'm filing are to get the deceased spouse's unused exemption. So if you are under the exemption.
Meaning the $15 million.
Under the $15 million exemption, you're not, there's no estate tax owed. However, if you file an estate tax return for the sole purpose of, if you're under the exemption, whatever you're under, you pass that along to your spouse, so they get a bonus. That's usually the.
So in other words, if your estate is 10 million, your exemption is 15 million, then you use 10 of it, you have 5 left.
Yes.
You can then, it's portability. So then it goes to your spouse.
Correct.
So you file a 706 to do that.
Yes.
Okay.
But I'll do that for large estates or where even though you're not there, the spouse could be later, and that little bonus helps. And you've got 5 years to do it. So after someone passes away, 5 years to file that, to file
get
it.
that.
Yeah. Okay.
Okay.
So even if you don't realize this for a few years,
that's good to know.
There can still be time. Now, CPAs, I think it just depends on the CPA, right? Some are probably more comfortable doing it, and some may just defer to an attorney to do it. I don't really know how it all works.
How do you all file the 706s?
Oh, we do.
Okay, you do that too.
We do file some.
Okay,
yes.
That's so interesting. So I've never. I was like, that seems that. See, this like the crossover there is so interesting to me.
As I've done them, and I started bare bone. I didn't, I have no real professional tax background, right? So I'm going into this, and it's a lot of information gathering, right? And CPAs, as I've done them, I can just tell, if you've done this enough times, you can just automatically just go. And I'm sure a CPA is. I feel like many of them are more trained than they think they are to do a 706.
Yeah.
I think there's some. There are.
Well, there are the ones filing like the
issues.
trust tax returns too, right?
Yes, and there are some
like titling issues.
There's some complicated elections that you need to make deeper into these 706s, which may, I think, give some CPAs some pause. But aside from that, I think it's pretty much. It's so information gathering. That's at least from my experience. Good question.
I don't know. I was just curious because it's like I've heard, I've seen it go both ways, and I am a CPA, but I'm not preparing. I'm not in, preparing the tax returns every day. I like I said, I got my designations, so I would understand when I'm doing a Roth conversion or I'm running a tax projection or I'm making a recommend. Like I would understand how the impact is. Otherwise, I feel like I'm driving blind if I'm making a recommendation. And so, but I'm not in. I don't do the daily what you do. So it's just interesting to me.
Yeah, we file 706s. We file more for portability than these days than we do for taxable estates. But that's because the exemption is, like I said, $15 million.
Yeah.
And then with portability, you get $30 million of exemption if none of it was used prior to the death of the decedent. But as far as you may not have an estate problem now, but as you mentioned, Arun, you may have one in the future. A $10 million account, if you don't dive into it, it can grow significantly.
Yeah.
Home values, if you have multiple homes and home values, they can go up and they can put you there pretty quickly. We've been fortunate during my career so far that the exemptions pretty much went up every year. So, it's grown significantly.
Gosh, I think when I started, it was like 500,000 and then it went to $1 million and then 2 million. I remember it's just been going up, but now it's so high that most Americans don't have that kind of money. But, with the wealth transfer happening with the baby boomers, and I'm seeing more of that now. So, the wealth transfer is happening. And so you have, unfortunately, people passing away and then they're leaving money to people who have already made money. And so I see it compounding. And then when we run projections, you can see what it grows to.
And,
also.
These are things that we don't, there are things that we don't control. A lot of times Congress controls, things.
Yeah.
They recently we had the most recent tax laws, and that made the exemption permanent for now. Whereas there were a few years there, we were speculating that it could pretty much be cut in half. And so
but we all know what permanent means.
Yeah.
Let's come on.
It's funny that they say it's made permanent until they change their minds.
It's permanent, meaning it's not going to sunset somewhere in some current tax law.
That's right.
But we all know that permanent means it for this year.
That's right. That's right.
Until something else changes. But yeah, I hear you.
Not all financial advice is created equal. Available now. Everything your financial advisor won't tell you. An eye-opening book that reveals what's really happening inside the financial industry and what it takes to build a plan that actually works. Because what you don't know could be costing you.
I feel like the coordination is really important, like we've talked about. And I think I feel like estate planning really breaks down when we're not coordinating, because it's like, okay, if I'm sitting here, like, for example, if we're talking about charitable giving, like, for example, I like to look at if a client is charitably inclined, can they do it from their RMD, the required minimum distribution, or can they gift appreciated securities, or, what have you? Sometimes we have to understand what's on the tax return to understand if they're actually going to get the benefit of the deduction or if they're just charitably inclined. We have to understand the movements of what's happening in your world, but also vice versa in our world. And I don't mean it's all the same thing, because sometimes accountants, I think, this is me, are looking at the information that's going into the tax return. Of course, you're talking to your clients. Of course, you're, talking about their situation, but sometimes you don't, I feel like maybe you don't have a full picture of the whole plan and the assets that are in it to be able to say, well, maybe you should gift appreciated securities here, or maybe you should do this here, and so that's where I feel like estate plans can really break down if we're not all working together. Because, if I'm advising on a type of allocation, or I know where they're withdrawing money from, but then you're looking at the tax ramifications, but then what is the long-term effect of the estate plan? I just feel like if we all work in silos, it can really just cause issues.
I completely agree. And I think a very basic one of those is how your beneficiaries are listed, right? I can do a fancy estate plan, but if you have beneficiaries that say something else and the majority of your assets are in those accounts, that's going to trump the design. And a lot of times, clients are busy. They've got a lot on their plate. They don't want to dive into all of this, and I'll ask clients, what kind of accounts do you have? Sometimes they don't even know. Right. They don't even know brokerage, Roth. They may not even know. It's just retirement account to them. And I'm not criticizing a client for that.
No, because it's confusing unless you're trained in this stuff.
It's very confusing, but just knowing that someone that is very wealthy and sharp doesn't know that, right? They're leaning on you completely for this advice. So you have to coordinate. You have to coordinate and just make sure, because reality is different than the few hours that you spend talking to them, right? And to for them to get the benefit of what I draft, or my advice, it has to be coordinated.
Absolutely. What have you seen any issues where what tax issues have you seen where maybe a recommendation was made, or not made, and because you were working in a silo, or the advisor or estate planning attorney was working in a silo, and so it caused an issue. Can you think of anything like that?
One that comes off the top of my head is you kind of hit on a little bit when you talked about giving a qualified charitable distribution from an RMD versus appreciated stock. Both of them are very valid giving strategies, but in today's with the standard deduction being as high as it is, if someone has no other itemized deductions and they gave $100,000 of appreciated stock, well, they just took a haircut of the standard deduction of $30,000. Whereas if they gave from their RMD, they'd get the full $100,000 of tax benefit. It wouldn't be taxable. So that's just kind of one that where if we're not communicating, if the financial advisor doesn't know whether the taxpayer or the client is taking the standard deduction or itemized deductions, they may just look at it and say, oh, you can give $100,000 of stock, but it may not be in their best interest to do it that way.
Yeah.
That's just one example.
And that's so interesting because we're talking about like capital gains property with giving stock. So that's already has a tax preferential anyway for a long-term capital gain if they were to sell it. And sometimes that makes sense because if you're not 70 and a half, which the required minimum distribution age has changed, but you have to be at least 70 and a half to do a QCD. And so even if your RMD ages later, you can do it at 70 and a half. And so if you're charitably inclined and you're doing it for tax purposes or not even, that is such a great point because you have that standard deduction. So if you were to give $20,000 of appreciated securities and your standard deduction's over 30, you didn't really get the benefit of the deduction because you already have it anyway.
That's right.
Right. So, but if you were to take that from, say, your IRA distribution or an IRA distribution, if you're 70 and a half, then that just, you don't get the deduction, but you avoid the income completely and it comes out of your IRA essentially for free.
Mm-hmm.
Right?
Yeah, absolutely.
Is that how you would say that? Sort of.
Sort of.
You just avoid the income on it.
Yeah. You don't pay tax on the distribution that it goes straight to charity. So that's the important part. Make sure it goes straight to the charity.
Don't take it and then write a check because that's not the same thing.
That's right. That's about the worst that you could do. But but another aspect of it,
because then you pay the tax and then you still don't get the benefit of the deduction because it's below the 30,000, right?
But also something to keep in mind too is once again it's working in conjunction with the team is that if you do a QCD, if you give from your IRA, that money was going to be taxed at whatever the tax bracket of your tax bracket, or if you pass away, then your beneficiary's tax bracket. But if you donate the appreciated stock, then you've lost that step up in basis, right? So the option is if you can deplete the IRA before you give the appreciated stock, and it's not going to be the best case for everyone, but in a lot of cases it's the better idea because the beneficiaries are going to get that step up in basis of stock, so then they won't have the tax. They won't even have the 20% or 15% or whatever it may be
on the capital gains, right? So thank you for validating that because that's what I usually recommend. Is if we're looking at a estate plan, and I think you agree with this, and if you don't, that's fine. You can tell me you don't. But it's like when I'm looking at a estate plan and it's like, okay, if you want to give some to charity, I prefer to give it not from a Roth, but I prefer to give it from a traditional IRA or 401k because the charity doesn't pay the tax, then they're not doing an inherited IRA distribution. Your heirs aren't. And then they get more of those taxable assets, meaning like brokerage assets, house, cash accounts, whatever. And if there are embedded unrealized gains, such as the house or the brokerage account, then they get that step up in cost basis, which essentially wipes out those gains. And then they don't have the ordinary income of the IRA.
My general recommendation is if give your beneficiaries, give the charities as from the retirement account. If you can do that, do it. So your beneficiaries have to pay less income tax.
Because a lot of people put it in their will, and then that's not doing the same thing we're talking about.
Exactly. Do it from your. It depends. If you have a revocable trust, it's a little bit easier to do it because you can get as customizable as you want within the actual trust.
And not having to name all the beneficiaries. You can just say my trust and then it makes it simple. And then you do the fancy wording in there.
Correct. And if you don't have a trust and you have a will and you're trying to make that, that charitable bequest, I probably wouldn't do it in the will. I would specifically and again, it's all going to depend because it's going to change in value. But if you could make that designation through your IRA, in a sense, your beneficiaries would be getting a larger piece of the taxable pie. But there's a lot that even you two just started talking about that I was starting to listen to it, and I'm like, oh man, I didn't think about this part of it and that part of it, and that's how this works, right?
Right.
Because we lean on everyone else on the team to help make those decisions too.
Right. Because all of us bring like a different perspective of what we've seen and different trainings too.
Well, it's important to mention, that most people are not going to be subject to estate tax. Okay,
right.
So when you give out of your will, you're not getting any tax benefit from this. So if you want to give,
as far as charity is concerned,
as far as charity,
because if you have a taxable estate and you give to charity, it's a deduction for your estate.
Yes, that's
but
right.
most people don't have $15 million in their estate.
That's what I'm saying.
Yeah.
Is that they're not going to have a taxable estate. So when you give out of your estate and you don't have a taxable estate, you're not getting tax benefit. Whereas if you give prior to passing, then you will get some tax benefit, which would leave more for your beneficiaries, or could leave more.
Yeah, absolutely. Especially from those retirement assets. Well, can you think of, some common estate planning mistakes that are made with clients? Maybe, is there one thing that stands out to each of you? I'm sure we see there's multiple ways to do things. And is there one thing that you have seen repeatedly that keeps happening with estate plans or having to do with any kind of inheritance or anything that comes to mind?
Well, for me, I've already hit on it a little bit, but that's gifting versus inheriting. Step up in basis versus taking the basis of the person that gave the gift. That's kind of a big one. It's pretty common. I would say other things I've seen, it's not super common, is to understand your plan. So there's multiple aspects to the plan. You create the plan, but then you also have to execute the plan, and then also understand what executing the plan means. So whether that means funding a trust. If you don't fund the trust, then
it's not doing anything.
It's not going to do anything for you.
That's what I was. Yep.
So there's it's about creating the plan, knowing what it's going to do, and then following through with the plan. Because I've seen people create plans and then they start backtracking because that's not what they wanted to do. So that's
because they didn't understand it.
I think that's been part of it.
Yeah,
is that they didn't understand what they were doing. Maybe they heard something and they thought it was what they needed to do, but then they realized that, well, that's not exactly what you needed to do, or they didn't realize the impact. Just depending on there's so many things that we can't cover everything right now. But
of course.
So. No, I'm with you on that 100%. The basic things like just check how your accounts are titled. Just check your beneficiary designations. What do you have right now? You may discover that you did something 15 years ago that you had no idea about, but it's still valid. And if things have changed, you need to make sure that asset is designated in a different way, or that you don't even need, there may be a trust that exists that you have, that's no purpose anymore at all. And just making sure that your plan is up to date. I think it's just checking in. Sometimes it doesn't even take more than 10 minutes, right? And you may discover something, or have someone else check it and they may, find a hole in there. So I think just making sure you're up to date with things.
One example, sorry.
No, go ahead.
One example of that is as beneficiaries on your IRA account, right? So I have seen, unfortunately, I've seen situations where there's been divorce.
Oh yeah,
and,
we've gone through this.
The beneficiary had not been updated. So an ex-spouse, maybe 20 years ago, was the beneficiary on an account.
Yeah.
If we see someone on a tax form that is not a name that we're familiar with, sometimes we'll ask our clients, hey, is this the correct beneficiary, or is this, we'll try to point it out to them.
Good.
So we try to catch that. We don't always get those forms when they don't have tax implications in the tax year, but when we see them, we definitely will speak about the beneficiaries. But that's one that can easily be overlooked. You set something and you forget it, and then it's not what you wanted when you pass away, or when that time comes.
Isn't that crazy? All of us are from different worlds, different firms, different, backgrounds. And we've all seen that where people forget to remove their ex-spouse from a beneficiary. And it's like, yikes. And there's nothing you can do.
And
there's nothing you can do. It's done.
One, I haven't seen it personally with my work, but it's to make sure you name those secondary beneficiaries. I mean, under the unforeseen circumstances that the tragic event happens and you both go at the same time, then you want to make sure that you have those secondary beneficiaries in place.
Good. I'm glad you talk about that with clients. I didn't realize that you all went that. I'm glad you do bring that up and go deep with them in that. I have a question that I've always wondered. So when there's a trust set up, like in a will, who gets the tax ID? Do you do that or do you do that? You're like, yes.
I will.
It depends who they call first.
Well, honestly, I tell them, listen, we can obtain this quickly if you want to. I can help you out with it. We can do it quickly
because there's no designated person that has to do it. I mean, they can actually do it themselves, right?
I mean, honestly,
they can just go online.
Sometimes I think they probably just should. It's a lot easier than people think it is. Now,
you just apply online, right?
If you can apply online. If you have someone with you advising you as you do it, that probably will help. But yes, you can obtain them basically instantly if you do it yourself. If you are applying on behalf of somebody else, it takes you submit it, they'll send it by mail, and with the IRS, I think you probably know better than I do. All bets are off as to when you may actually receive something in the mail from the IRS.
Yeah, the important thing when you apply for an EIN is that you make sure you get it off your screen there. Make sure you print the confirmation. Mm-hmm. You get the EIN because once you get past a certain screen,
you can't go back.
You don't have it. You don't go back.
Yep, everything is lost. Every teeny little thing that you did. My every time when I click that button, my heart skips a beat each time, and I'm like, please, and then it goes through.
Yeah, no, I do screenshots. I do screenshots of what I've keyed in and everything, and I can do it all. But no, it's like
CYA.
Yeah, you don't want to depend on things getting to you in the mail. I mean, for the most part, it gets delivered and everything's fine. But
who sends tax IDs or EINs in the mail anyway? Because then that's how identity theft happens,
It's a whole nother topic.
Because you can't even I know, right? We could do so many topics on the show. I really want to do one on trust. We should do that. But I guess as far as gifting, I just am curious, what tax issues do you think should be reviewed before assets are transferred or gifted?
Well, I mean, definitely basis. I mean, you definitely want to look at basis to see, what situation you're in.
And that's what they paid for. That's what they
that's right. That's what they acquired it for, or in the event that, I've seen gifts happen over a multi-generational period. So where a grandfather gave something to their grandchild. So their grandchild's basis is what the grandfather paid for it, which could be next to nothing for 50 acres of land somewhere. But then when, if that person gives it, then the basis is still the grandfather's basis. So tracking basis through those gifts.
Yeah.
You want to, if someone, especially if they're, late in life, toward the end of life, most of the time it's probably better off to, when it's an appreciated asset to let someone inherit it, to make sure that you get the, the beneficiary right, through whatever means it is, whether it's trust or specifically identifying who you want to receive something. I would say
just so it gets that step up in cost basis.
Absolutely. Yeah. And then another thing to keep in mind too is does the beneficiary want what you're giving them? Okay. And I say that like if you have a lake home, say you have a parent, they have two adult children, and one of them lives in California and one of them's here in Georgia, and their lake home's here in Georgia. The person in California has no interest in it whatsoever. Yeah. Well, do you want to work your planning out to where the child here receives the home that they want, that lake home, they want it, to work it out in that way instead of them splitting it 50-50.
And then they have to buy them out and figure it out.
That's the part I'm going to echo that too, because if you aren't completely clear, if you don't envision, well, what happens if they just don't want the same thing? That can
you have to
create.
Plan for
you have to maybe put a provision in there that says if you can't make a decision within 100 days, I'm going to make the decision for you, and this is what happens to it. Even knowing that they'll probably work it out, but they don't always work it out, and when they don't, that is when things can get really ugly. There's money involved, there's hurt feelings involved, emotions involved, and then I have to zoom out too. beyond just the legal landscape of it. And, what do you want to move on with your life? How do you want to get better? Everything has a value to it, and it's hard to put a dollar figure with everything. But when things get really ugly, it's really sad, and it can easily be avoided. Easily be avoided.
Yeah.
Another one. I use the lake home as an example, but a business. Does the beneficiary want to do that business? Is that what they want to do? Should the business be sold prior to death, or what's that going to look like? Because if someone doesn't want the business, once the original entrepreneur is gone,
right,
then maybe they won't care for it the same way. Maybe it ends up dissolving and being one of those cases.
So the entity
right?
structure and the business continuation or not, and then transfer planning with respect to the business and all of that, because that's where I think it's important to know. That's where we would all get involved too, where it's like we identify this potentially, or maybe one of you do. And then, understanding the structure of the entity, and then you understanding the tax ramifications. And this is where it's like, okay, well, maybe the heirs will get the assets from it, but is it actually the business, or can you have like life insurance in place, for example, to help buy out the heirs? So it maybe goes to the employee. So having that succession planning is huge, or understanding what happens to it at that point.
Absolutely.
That's a whole nother topic too.
Usually, beneficiaries don't want timeshares. I will say that. That's something that they're left with that, and it's a huge headache. Businesses, maybe, hey, they could get timeshares.
Timeshare.
Yeah, they're
interesting.
They're not fun for beneficiaries to deal with.
Or people while they're alive. I feel like it's like that feels like it's always a problem, and so it's like you got to sit through this thing, and then I don't know. And so just but go on vacation.
Yes,
I don't know. So really, in summary, I think there's a really good list of questions that, as a listener and a client, you should ask your professional team. So really, questions for the attorney, I would think, do my documents reflect my current wishes and family situation? Are my powers of attorney and healthcare directives up to date? Should my assets be titled differently to align with my plan? Questions to ask your CPA could be things like, what tax issues should I consider before making gifts or changing ownership? How could my estate plan affect my heirs from an income tax perspective? And are there any upcoming tax law changes I should be aware of? Which that's probably ongoing anyway. And every time something comes out, we're digesting that or trying to. And then maybe questions for your financial advisor. Do your beneficiaries match your estate plan? And that's something, of course, that's something that overlaps as well. Will my surviving spouse or heirs have enough liquidity? So that's a huge thing, because if we're talking about doing charitable giving or what have you, what does it look like if I pass away? And does my financial plan support my legacy goals? So really, a question for the whole team, I would think, are all of you working from the same assumptions? So making sure that, your advisor, your CPA, your estate planning attorney are all working from, the same assumptions, and we all know it's on the same page. So really, I guess in closing, when do you feel that an estate plan should be reviewed?
Every 3 years, I would say.
Unless there's a change.
If there's a major life event, that's a signal to get everything reviewed. But I'll tell clients, listen, if you just want to call me up and you just don't understand what your documents say, I'm happy to prepare a review for you. I think it's a good idea to know what you have if the worst thing happens.
Mm-hmm.
That's actually a question for you, Arun. Is there do you generally provide like a summary or anything like that for people on what what their plan is? Because if they have a summary, not a full estate plan and will, but if they have a summary,
like all the documents in this binder, it's hard to digest.
Right. And then it takes you just hours upon hours to figure out what's going on. But if you have a summary, you can look at it periodically. 3 years sounds reasonable. I don't have a time frame in mind, but definitely periodically. Don't just go a decade without looking at something, especially, if you have, named charities, is the charity still around?
Yeah.
Has it merged, or do they still have the same values that the charity had when you wanted to give them in the first place? So lots to go, lots of aspects to look at, but definitely, outside of big events where that that you need to change something, such as marriage, divorce, birth of children, or whatever it may be, just periodically review that summary and make sure it's still in line. And it could take 10 minutes. It could take a half hour.
Yeah.
Do it over coffee or lunch, and then you can put it away for a period again. So.
Absolutely. No, I agree with you. And, we try to review it. We do review it as well. And so every couple of years or when something changes, but no, it's great. I'm so glad we got to do this together. I hope we get to do more together. I would love to do one on like trust or something. That would be fun. But, it's so important to have these connections and work together. And, it's invaluable relationships to be able to work with clients together and be able to trust each other and help each other. And so I appreciate both of you coming this morning and doing this. And if you want to reach Arun, we have, estate planning attorney. We have a link to his website there. And also for you, Jordan, a link to the website for Jones and Kolb there. So if you want to reach out to them to ask questions or, to work with them, you certainly can. But thanks for listening to today's episode. And if you're interested in learning more about Wiser Wealth Management or want to schedule a consultation to meet with one of our fiduciary financial advisors, you can do so by going to wiserinvestor.com, or you can click on the link in the episode notes. We'll see you next week.
Thanks for listening to a Wiser Retirement podcast. We hope you enjoyed today's episode. Make sure to subscribe wherever you're listening. That way you don't miss any new episodes. We'd also appreciate if you could leave a rating and review. If you have any questions about anything that was discussed today, head to wiserinvestor.com and reach out. This podcast is strictly for informational purposes only and is not to be considered as investment advice or solicitation to buy or sell any financial products, securities, digital assets, or any other investment vehicles, or a basis to make any financial decisions. Wiser Wealth Management Incorporated is a registered investor advisor with the SEC. The host and/or guests may personally own securities, digital assets, or other investment vehicles mentioned on this podcast. Neither the host nor guests of the show are compensated for their participation, and no referral fees are paid to or received by any host or guest for clients, listeners, or similar interests. Investments involve risk, and unless otherwise stated, are not guaranteed. Be sure to first consult with a qualified financial advisor, tax professional, insurance professional, and/or legal professional before implementing any strategy discussed herein. Past performance is not indicative of future performance.